So I'm gonna do what I do, guys, and let's just go ahead and start straight from here. Um, Easiest way to get to where you want to be, and guys, this isn't just for new people. This is for you guys that have been with me for years. Posting your trades in class, guys. Just get feedback. Um, I can't overstate how important the feedback is in the learning process. I believe in it wholeheartedly. Guys, I use John Novak as a sounding board every day. Every day, he and I look at patterns. Every day, he and I talk about setups. Every day, we talk about management, things that we notice. And guys, I use a coach for every one picture that you give me, I give him 10 and he gives me 10 and we go back and forth. And really that feedback, being able to just have somebody who has no emotional attachment to what you're doing pays huge dividends. So post your trades in class, guys, and track them on your spreadsheet. Going back and looking at the trades that you take, going back looking at the patterns that you see, recognition comes through the repetition, guys, through seeing the same thing, through hearing the same thing. So we're going to take the first hour. We're going to learn the rules for the high probability trend trade. We're going to focus on 3 simple rules, 2 charts, making sure that you guys are comfortable with that trade, because that high probability trend trade is the one that teaches you to read your indicators. And once you can do that, options are limitless, guys. Simulate, practice. V, don't wait until you think you're good at it. Just go ahead and get on that simulator. If you think you see a trade, take a trade, right? I got you, Ron. You know, I find this is a very true cycle. Um, is my battle cry is always simplicity, right? I'm always saying keep it simple, guys. Don't overthink it. My brother is for every one tree of the forest that I see, he sees 10,000. Um, and it's funny because we balance, because he loves to add more. He loves to look for more charts, more triggers, more this, more that. And I keep going back to simplicity, and it's funny because he always comes back to simplicity too, but he's got a creator's brain, so he focuses on these things. Guys, it doesn't take a lot to get to where you want to be. Post trades, learn patterns. Yeah, I saw that, Pete. I saw that. Somebody sent John an email saying, hey, guess what? I'm trying to sign up for the demo, so it's okay, you'll know. And Ron, that's exactly it. The more you look for, the less you find. Or you find the losers. That tends to be it. So guys, simulate, practice, but practice rules, and that's the key. Rules should provide a statistical advantage, guys. Rules should be based on patterns that win more than they lose. That's the whole basis for what we do here, guys. Is it's not finding every opportunity to make every penny that's traded in the markets, but rather find the highest probability opportunities, so we can minimize risks, maximize profits. Keep it very, very simple. Know what looks you're going to commit to. Take those pictures, ask those questions, learn your rules. And then, guys, ask for help. Ask for feedback. You've got to know what you did right or wrong in the beginning. You really do. So every time you take a trade, every time you look at a chart and you have a question, talk about the reads. What do you see? Tell me what you see, and then we'll just talk about it. We'll make sure that you're reading your indicators correctly. Go back and use that spreadsheet. Make it a trade journal. Study it every morning. Whatever you did on Wednesday, you should be looking at this morning and saying, man, that worked and that didn't work. And this felt easy and this felt forced. And if you repeat that process every morning, and again, so many people don't do this. So many people don't go back and just say, hey, wait a minute, what worked, right? Some people in the room traded directly into termination conditions on Wednesday and lost a lot. And hopefully they're looking at it this morning going, man, I shouldn't be trading into termination conditions. Some people on Wednesday traded with momentum and a clear path and found a great amount of success. Hopefully they're looking at it this morning saying, man, I want to repeat that process. And that's all this does, guys. Every morning, study your trade journal. Make sure that you're following rules. Make sure that you're giving yourself the advantage. And let's repeat the things that are helping. The easiest way is to do it with a high probability trend trade, guys. This is a trade that typically wins 70 to 80% of the time. This is a trade that creates confidence through the memory of success. This is a trade that teaches you to read your indicators. And chart reading is about 90% of your day. 10% of your day is actually trading. 90% of your day is waiting for your rules to be met so that you can take a trade. This high probability trend trade only has 3 rules. The first rule is that you have to have, strong triggers, because strong triggers create the advantage of momentum. That's your first momentum, guys. Momentum, I've seen entire trading plans built around that one simple advantage, but we're going to couple it with room to our profit targets by not trading into what we call termination conditions. And when there are no lines on the big chart creating problems, guys, you're going to have a clear path, which means that you're going to be behind the wheel of the fastest car you've ever driven, and there's absolutely nothing between you and your targets. There's your clear path, right? It's hard to stop. Huge advantages. And then initially, rule number 3 is going to get you into the highest probability trend trade. You will find other entries. You'll find entries that make sense to you. But if you go back to every rule that Nexgen teaches for every trade, in some form or fashion, momentum and clear path is going to come into play. So make sure that you learn these 2. And we're going to keep it simple. Only 2 charts to find those 3 rules. Your large chart is a slow chart. It's a very broad stroke of a brush. And on the most current bar, that one bar at the very front of the lineup, guys, you're going to be able to define direction, momentum, and areas. Rules 1 and 2 are going to be met on that large chart. And you'll have 66% of your advantages before you ever enter the trade, or before you ever look to the smaller, faster chart to enter the trade. This small chart is a refinement chart, guys. It takes that... Guys, will you give me a Y if you can hear me, please? Pete just said no audio. Is it just Pete? Yep, you guys have me. Okay, let me see if I can help Pete out here. Pete, Control, Alt, Delete. There we go. Guys, sometimes audio is going to mess you up. More often than not, it tends to be on your end. Reboot. And when you ask if, or whenever you can't hear me, post it in the room. If you see 10 Ys come up after, then that's letting you know that it is on your end. Guys, once the rules are met on the large chart, we're going to talk about the entry on the small chart. Good morning, Kenan. You know what, Steve? It's just a tool, right? And in a digital age, there's so many factors that can play into things. Pete may have a rough Wi-Fi connection, right? Sometimes you got stuff running in the background. It is what it is. I just don't get upset when things that aren't human mess with me, because they don't know any better. They're just machines. Guys, the entry chart is a small chart. It's a refinement chart. It's going to take the one bar on the large chart and turn it into 15 to 30 bars to help you find that entry for the highest probability trend trade. By using that refinement process, you're going to reduce your risk a lot, dramatically. And you're going to increase your profit potential. And rule number 3 gets you in. So you've got only 3 rules and only 2 charts. And we use these 2 charts because they pretty much remind you who's in control. The large chart is the large crowd, guys. It's the people that move the market. It's the people that create momentum. The people that react to those key areas on your large chart. And then the small chart is just the small crowd. It's this little group of people that can create a fight, that can push back just a little bit. But these guys fail 70 to 80% of the time when they try to fight the large crowd, which is why we're going to use them to pinpoint exactly where to enter at their failure point, and that becomes your entry for the highest probability trend trade. So let's go through the advantages. Remember, guys, it's on you. If you don't understand a concept, you need to raise your hand. If when I'm talking about momentum, you're like, dude, that just doesn't make sense. It's on you to say, hey, Mark, I need a little help with momentum, and I will stop what I'm doing and we'll do momentum lessons until you're good. But I can't see your faces. So if you're having challenges, but you're sitting there going, I just don't understand this, then I need you to take responsibility for that, to raise your hand, to ask the questions. At least give me the opportunity to help you rather than sitting there and not understanding. So when the background is green on your large chart, the market's going up. That's the most basic lesson that you'll ever get. Green is up, red is down. In order to have rule number 1 met, in order to have strong triggers, the advantage of momentum on your large chart, the small triggers have to be up and above the large triggers. The large triggers should be wide and angled in the direction of the trend. And guys, your trigger lines have to be green as well. Otherwise, you don't have strong triggers. It's the space created between the small and the large. It looks like scissors that are opening. Guys, this lets you know that the odds are favorable for the market to continue in the direction of the trend. Or, of course, when it's going down, the smalls are below the large. They're widening the space between the two. Those open scissors let me know that the odds are favorable for the market to continue down. When you have strong triggers, you have what we call odds favorable momentum. That separation between the small and the large is the absolute best of the best look for momentum. And this is where you'll use that smaller chart to buy Fibonacci support or sell Fibonacci resistance. On your large chart, it looks like a tail. We do not trade tails, guys, but you'll be able to use these tails to go back and study. We trade retracements on smaller, faster charts, pullbacks, but they look like a tail on the large chart. You'll be able to pinpoint exactly where these tails are most likely to form. Strong triggers leads the way, guys. Strong triggers pushes the market. Strong triggers can break key Fibonacci areas. Strong triggers can even cover a lot of mistakes that new users make. Strong triggers are, man, I don't want to do without this advantage. And like I said, there's a lot of plans that are built around strong triggers. And then when your scissors close, when the smalls return inside of the large, we call this a weakening of the large triggers. I personally think that in order to really have that highest level of confidence with momentum, you should be able to recognize strength. And then it's equally important to recognize weakness. And when I have these weakened triggers, guys, anything can happen up or down. I'm a huge fan of language. And just speaking to yourself in terms of strong triggers, odds favorable. Look at that. Strong triggers, breaking key areas. Tails, those retracements all the way down. Strong triggers pushes the market up, breaks key areas. And then sometimes you get all that indecision. And guys, that's holiday right there. That's the market bouncing off of areas. And then eventually those strong triggers push it up. Then the smalls return to the large. And now it's heading down. And can everyone give me a why if they can see that on this most current bar, we have strong triggers? V, does it make sense? Andrew Z, no worries there? Izzy got game? That's strength, ladies and gentlemen. That's the best of the best. That's the strongest trigger look that you could ever hope for. This is the look that has the potential to break areas. This is the look that covers mistakes. This is the look that has me looking for these tails to try to take advantage to find an entry. So strong triggers, guys. Best of the best. New users, commit to momentum. When you grow with the software, when you start getting good at reading your charts, when one line goes in, you're going to say to yourself out loud, you're going to scare the parakeet. And you're going to say, man, I'm losing momentum. I no longer have odds favorable momentum, but I'm so stinking good at reading my indicators, I still might find an opportunity. And then when you get those anything can happen triggers, guys, those weak triggers, you should say to yourself, hey, anything can happen. And when anything can happen, that's not an advantage, guys. That's a hope or a wish. And then when these anything can happen triggers show up at areas, those areas are more likely to hold. And that's our segue to rule number 2, guys. Once you have the advantage of momentum, and again, I try to never do without momentum. Once you have momentum, you have to make sure that you have room to your targets, guys. So large chart, lines on the large chart are where the large crowd make decisions, guys. Lines on the large chart are where buyers are buying and sellers are selling. And lines on the large chart are where fights can happen. And these lines on the large chart can be trouble. That's why termination conditions originate on the large chart. So we're looking for divergence high lines, these magenta lines that come off of pivots where there's a loss of momentum. We're looking for resistance, yellow 1-to-1s. We're looking for blue Fibonacci support, divergence low lines. And all of these lines represent a point where the large crowd, where the people in charge are going to make a decision. Sometimes the decision is going to be that they're going to stop the market cold and the other side's going to take over. Sometimes there's no resistance at that decision-making point and odds favorable momentum pushes through. And then when you couple those weak triggers and a decision-making point, that's when the area is most likely to hold. So we're going to use our trigger lines. And our trigger lines are going to let you guys know if these areas are likely to stop the market, in which case they're a termination condition, you no longer have a clear path. They're going to let you know if they have the potential to break, which is just potential. It doesn't mean that they're broken. It doesn't mean that the path is clear. And they're going to let you know if these areas have broken. So these key areas on the large chart: support, resistance, 1-to-1s, divergence, highs and lows. Hey, Muser. It's a pretty simple process. If price reaches an area, that's what sets off the decision-making process, guys. If you're the third car back in the McDrive-thru, you're not ordering yet, right? You have to get to that point to make your decision. So decisions are made when price reaches the area. So when price reaches that area, all you guys have to do is ask yourself, where are my triggers? If the trigger lines remain above support, below resistance, when price reaches that area, you've reached a termination condition. And I'm going to tell you guys right now, every line that you reach is going to be a termination condition, at least for a fraction of a second. All you have to do is say, man, I just don't know. I just don't know if it's going to break, if it's going to hold, if it's going to bounce. This is your termination condition textbook. And then this termination condition is no longer a factor. It's no longer in play when both the small triggers and the large triggers get to the other side of whatever line you've reached. So whether it's support, resistance, 1-to-1s, divergence highs, divergence lows, when the small and large triggers get to the other side, the area is broken, the path is clear. And guys, that is the most simple approach. And I want you to see this. This is how rule number 2 saves bacon, guys. Rule number 2 is the most broken rule out there. Price reached a divergence low. The triggers remained above. Absolutely no short trades. Kept you out of trouble. Price reached a divergence high. Triggers remained below. Absolutely no long trades. Kept you out of trouble. Price reached yellow 1-to-1s. All the triggers remained above. No short trades. Kept you out of trouble. Price reached resistance. It had the potential to break. It never did. Price reached yellow 1-to-1s. It had the potential to break. It never did. Guys, I'm going to give you a plan for taking those potentials, but look at this. Resistance, support, divergence 1-to-1s. Guys, that's holiday trading, but this is rule number 2, keeping you out of a truckload of problems. Smalls and large break. Resistance becomes support. Look at how support holds to continue the move up to resistance. If you scroll back on your large chart and you just study a little bit and you say to yourself, man, price reached the area, my small triggers made it through, my large triggers didn't. Guys, there may have been an opportunity to find an entry right there. We'll go back and we'll study it when we get to entries, but is everybody good for the moment? If price reaches, sit on your hands and do nothing if the triggers are below it. And that's going to happen pretty much every line. Smalls and large get to the other side. Let's look for rules to be met. And then there's that potential, guys. When the small triggers smash through an area, but the large triggers are lagging behind, this is an area that has the potential to break, but it's not broken yet. Which means that it's not a clear path. Which means that under no circumstances can you tell yourself, rule number 2 is met. So these potential to break trades, guys, these are not high probability trend trades. These are not trades that typically win 70 to 80% of the time. But I'm going to put in your hand today the best of the best way to take these trades with the highest chance of success. So you're going to walk away from today understanding 3 rules. You're going to walk away from today with a solid plan how to take 2 trades, and you're going to walk away from today with the ability to study these trades and the parts that they come. I'm going to give you everything you need. But I'm also going to do this. This is my favorite picture in all of Nexgen history. This is the picture that reminds me that 90% of my day is doing nothing. 90% of my day is waiting for advantages. 90% of my day is sitting on my hands, twiddling my thumbs, waiting for momentum, a clear path, and then ultimately the entry area. Sometimes the market's going to absolutely scream down and you're not going to get an entry. And I mention this because rule number 2 is the most broken rule, and it's typically broken when you didn't make any money to that key area because your brain tells you, man, if I'm not making money every 18 seconds, I'm never going to make money. But the reality is the futures markets trade billions of dollars a day. You're only trying to capture about $250 per contract, guys. So when price absolutely screams, you don't find an entry, but it hits these 1-to-1s, where are my trigger lines? They remain above the trigger lines. No short trades. And look, there's that untradeable bounce. There were buyers waiting and there were sellers jumping ship right at this key area, and they push all the way up to resistance and all the triggers are below. Well, shoot, now I can't go long. And my triggers don't agree, which means that I don't have momentum, don't have a clear path. Guys, only the potential. And this goes on for about 45 minutes to an hour where you're just saying to yourself, I just want to trade. I just need to get into the market. I just have to get paid. And guys, it's not uncommon to see people lose $500 forming opinions, hoping something breaks. It's not unusual to see people giving away $1,000 without the advantage of momentum to break these areas. We just don't expect them to break. But the cool thing is, if you learn to exercise your patience, if you learn to do absolutely nothing when your rules aren't met, when those advantages aren't in play, eventually the smalls are outside of the large, and eventually all the triggers are above the lines, and eventually you pinpoint exactly where that tail is likely to form. And this becomes your 10%, waiting for that high probability trend trade, guys. And the concept of making money as a trader, this was about a $450 trade. If you gave away $500 through your opinions, you're still down $50 in commissions. Or if you gave away $1,000, you're still down $550 despite taking the best of the best, highest probability, easiest to recognize trade that there is. So I want you to, from day one, and this is for you guys that are brand new, I want you to keep it pretty simple. And every time you take a trade, let your only option be rules met. Give yourself that advantage, create that confidence, and you will find trades outside of that high probability trend trade. You'll find these medium probability trades, these trades where there's the potential, right? And what happens is it's not the money you make. It's the money that you don't give away when you don't have an advantage. So is everybody good on termination conditions? Pretty simple concepts. This one has the potential to break. And you can see that there's still a fight happening there. This is one of the things that I think is pretty cool about the smaller, faster chart, is you can literally see the up, down, up, down, up, down, up, down on a smaller, faster chart when the large chart can't give you that information fast enough. And if let's go to crude oil as well. Let's see if termination conditions are kind of an all-over sort of thing. Where's my large chart? There it is. Post-holiday trading. But check it out, guys. I have a fib and weak triggers, and it pushed down right in the middle of the night when no one's even awake. And it pushed all the way to support, that pushed it all the way back up to a pivot stop out, that pushed it all the way back to support with the potential to break, back to resistance. Guys, rule number 2, during the holiday is a huge pain in the ass. But look how resistance, weak triggers, reverses the market, gives odds favorable, takes you all the way to the next key area. Weak triggers say do it. keeps you out of consolidation. A lot of you guys caught this trade on Wednesday. A lot of you guys caught this trade on Wednesday. But you're trading from areas rather than trading into areas. And it's pretty cool because if you just learn a few key concepts, guys, you're going to have the ability to catch the highest probability trend trades ever. So everybody's good, right? Momentum, separation of the triggers, lines on the large chart or termination have the potential to stop the market. That's rules 1 and 2, guys. Sometimes the market turns from nowhere. Odds favorable, momentum, everything says up, haven't reached an area, and it drops like a ton of bricks, guys. This final termination condition is the only time where I'll let a small chart tell me that rule number 2 isn't met, and it's 3 divergences on a small chart. Divergence is nothing more than a loss of momentum, guys. When the market goes down and up, right about the 3rd bar, the calculation is done. You'll see a cyan line from a low or a magenta line from a high. And all it's doing is it's saying, hey, guess what, Pete? Momentum isn't following price. Guess what, Surgeon? Momentum is not following price. Hey, Muser, I don't know if you knew this, but when that blue line prints, momentum is not following price. 3 losses of momentum in the same price range, guys, can terminate a trend. It's a visual. 3 divergences in the same price range may terminate the trend. Becomes more powerful. You guys remember that anything can happen trigger look? So now I have weakness in the triggers, 3 losses of momentum, guys. This is even more powerful, and it becomes more powerful still if that 3rd pivot's higher than the previous from a low or lower than the previous from a high. And you'll be able to see this on your small chart when you can't see that change happening yet on your large chart. Right here, rule number 1 is met. I have odds favorable momentum. Rule number 2 is met. I haven't reached Fibonacci resistance. I go to my small chart to look for an entry, and 3 divergences says, hey, Mark, don't do it. We're changing direction. And guys, that's how you use it on the small chart. So large chart leads the way. Large chart gives you 66% of your advantages. Strong triggers, no termination conditions means that I have momentum and a clear path. Let's figure out how to get into the market where the market is most likely to continue. Rule number 3 says that I'm going to use a limit order. I'm going to be so precise on my entry, I'm going to wait for the market to come to me. I'm going to use a limit order at an area, fibs, mid-bands, yellow 1-to-1s, guys. Lines on the small chart create bounces in the direction of our trade, as opposed to lines on the small chart stopping our forward progress. But I want those areas to be inside of triggers, guys. I want those areas to be inside of trigger lines. So I'm going to use that 2-chart process. Odds favorable momentum, clear path, and then I'm going to let the small crowd do their thing, guys. I'm going to let them fail right at an area inside of triggers, and this becomes my entry for the highest probability trend trade. So I'm not trading tails. We said that you could go back and study using these tails. If I circle this tail when I have odds favorable, if I circle this tail with that clear path, that circle should show up at an area of support inside of favorable large triggers. This is you using the refinement process. The top of this bar is the beginning of your pullback. The bottom of this bar should be your areas inside of triggers. And guys, the next bar doesn't even form until up here. So if you wait for a tail, you miss the trade. But if you learn this simple little recipe, you're going to catch it at the best of the best spot with the absolute least amount of risk, guys. So when it says areas inside of triggers, you're going to have 2 looks on your triggers. One of them is the best of the best, the least amount of risk. The other one creates a little indecision. So we're going to look for areas inside of what we call favorable large triggers. When your large triggers on your small chart and your synthetic triggers, hey Adamos, good to see you, on your small chart, overlap, one on top of the other. 2 snakes riding piggyback. Guys, this is what we call favorable large triggers, the least amount of risk, the highest level of precision. And we do that because these large triggers are where price typically comes back to. So we've taken the large chart large triggers and the small chart large triggers, and we've put them on one chart, the small chart, and it gives you the tightest range when they overlap. When they separate, when they begin to split, when your large triggers are up here, your synthetic triggers, which is a fancy way of saying your large triggers from your large chart, are way down here, it creates indecision because I expect price to return to the triggers. And when they're far apart, I've doubled my correction point. When they're one on top of the other, it's very consolidated and easy to find the areas within. So we're going to use a limit order to buy or sell a pullback at an area inside of favorable large triggers. That's the whole wordy way of saying rule number 3. So when everything says up on the large chart, the reversal bar begins the pullback. The reversal bar signals the fight. The reversal bar is not the entry for the high probability trend trade, but rather this is what sets off your process of finding your window of opportunity where the market is most likely to continue. So at the time of the reversal bar, I'm going to find those trigger lines, large and synthetic. I'm going to make sure that they're one on top of the other, that they're overlapping, that they're creating what we call favorable large triggers. But it's not the trigger lines that are my entry. The trigger lines are where I expect price to return to. But inside of trigger lines, I'm going to look for fibs, mid-bands, and yellow 1-to-1s. And for a long trade, my window of opportunity, the point where the market is most likely to continue, will extend from my highest point of support, in this case a mid-band, to my lowest point of support, these yellow 1-to-1s, inside all caps of favorable large triggers. The blue box is where the market is most likely to continue. And guys, this blue box is still 10 ticks wide, right? We're good, but come on. We're talking about a market with thousands upon thousands of traders, and we will refine it to this one area. So much so that you're going to develop the confidence to right-click on your chart and activate a limit order at the top of that window. Couple ticks above the highest point of support. This becomes your entry for the highest probability trend trade that you can possibly take. In a short trade, we wait for the reversal bar. The reversal bar is not the entry, but rather it signals the beginning of the pullback. At the time of the reversal bar, I look for my favorable large triggers. Large and synthetic, one on top of the other, super tight, very consolidated, giving me the smallest correction point possible. I'm expecting price to come back to those triggers. The triggers are not my entry. I'm looking for lines inside of triggers, fibs, mid-bands, yellow 1-to-1s. And guys, I've got one line inside of these triggers. It's a mid-band. My limit order goes 2 ticks below that mid-band. My window of opportunity is 1 tick wide. Sometimes we are that precise. I'm going to get into the trade knowing that I have the advantage of momentum, knowing that my path is clear, and understanding fully that this is my highest chance of success. I'm ignoring these lines outside of triggers because I don't expect price to correct up there. I expect it to happen inside of the triggers, guys. So when your large chart says up, when the path is clear because the small and large are through, at the top of the bar, when it's all the way up here, when you're fearful that you're losing out, that you're not getting paid, magically those reversal bars happen, guys. There's always a fight in the market. At the time of the reversal bar, I'm going to find my triggers. The triggers are not my entry. The reversal bar is not my entry. My entry comes from the highest point of support inside of favorable large triggers. Guys, this is your high probability trend trade. And if you spend 20 days, your first 20 days with Nexgen, by the end of your demo, you guys that are on demo, you're going to know that this works because you're going to see people posting this in the room all the time, people making money off this very pattern. But if you give me 2 to 3 weeks of only focusing on high probability trend trade entries, you're going to become a chart reader. And your chart reading is going to open doors. You're going to recognize momentum. You're going to understand when these areas can be problematic. And you will be able to pinpoint exactly where the market is most likely to continue. This is my goal for each of you in the first 20 days. Don't be in a hurry to break outside of this highest probability scenario. Learn to pinpoint exactly where the market is most likely to continue. Because once you do this, you know where the market shouldn't go. You're going to say to yourself out loud, scaring the dog, frightening the cat, making the fish turn circles in the bowl, man, If price goes beyond this correction point that is the triggers, if price goes beyond these areas inside of those favorable large triggers, well then this is probably that 20 to 30% where I'm not going to win. And you're going to have this faith in it. You're going to know if I take this entry 10 times, I'm going to lose 2 to 3. And you become okay and comfortable with the idea that every trade isn't a winner. What you'll be focusing on is whether or not you followed the rules, whether or not you had that statistical advantage. And guys, it's surprising and it's kind of weird, but you're going to be okay with losses. They're a normal part of a positive equity curve. But the great thing is that with all those advantages in play, typically 70 to 80% of the time, that market's going to head in the direction of your trade. You're going to get a reversal bar in the direction of your trade, and you'll be able to reduce risk a couple ticks above it, a couple ticks below it. And guys, by pinpointing where the market is most likely to continue, by being patient and waiting for the area inside of those triggers, what happens is a lot of the times you're going to get one of those reversal bars, even if it's one of the ones that won't work. And you'll be able to reduce your risk to a point where maybe you're giving away $40 or $50 rather than $200 a contract. And minimizing losses and being able to maximize your profit potential is everything that we're looking for, guys. At the time of the pullback, you might be 5 ticks from a fib. From the area inside of favorable large triggers, suddenly you're 27 ticks from a fib. Don't get caught up on small triggers rolling against you. We need that loss of momentum on a small chart to get us to our entry. And you have to remind yourself, momentum is defined on the large chart. On the large chart, you're still going to have odds favorable momentum. Don't get caught up trying to trade the triggers, getting fooled by fluctuations, guys. Commit to taking your entry at the proper entry. It's going to reduce risk and it's going to maximize profit potential. And guys, that is the high probability trend trade. That is the best of the best. That's the trade that creates confidence. And this is pretty cool. Check this out. It had the potential to break and it never did. 3 divergences printed in the same price range. That's a pretty cool indication, right? But even on the way down, I want you guys to see something. Pull back to the mid-band to resistance right inside of triggers. Pull back to the mid-band in yellow 1-to-1s right inside of triggers. Even one more right at the mid-band inside of triggers before third divergence says, get the hell out, we're about to go up. Guys, you're going to be able to see this pattern over and over and over. And let's go see. If I circle a tail, I'm going to go back on a small chart. I'm just going to ask myself, what did it look like? Well, it pulled back right to the support, right to the yellow 1-to-1s. But the reality is, guys, 3 divergences, that might not have been my trade. And there's so much holiday trading. Let's scroll back past the holidays real quick. I want to say a lot of you took this trade right around noon. So let's scroll back and see if we can find the circle. I may have missed it. That was the short. There it was right there, guys. Pull back directly to support, right and south. Pete, it's the exact same rules. Divergence stays in play until the small and the large get to the other side of it. Same as a fib, same as 1-to-1, same as divergence highs. I use the exact same idea. Until small and large triggers break a divergence, that divergence is going to stay in play. So this divergence is solid until the small and large get to the other side of it. And then my count starts again. Good question, good question. So guys, any question about momentum? Any questions about termination conditions? Price reaches resistance, triggers are below. I have to pause for a second. I don't have a clear path. Any questions about finding your entries? Guys, you've got to study this. Only watching this classroom, whether it's live or on video, and expecting to become a confident trader man, you're putting a lot of pressure on yourself. You've got to learn some pretty simple looks. You've got to be able to understand when you have these advantages. And the easiest way to do that, guys, isn't from taking trades. The easiest way to do that is to go back and start taking pictures. And I put this together. This is my chart reading 101. If you go back, and I'm going to say this with the utmost confidence, maybe even a little cockiness, if you take the time to go back and take 25 pictures of strong triggers and 25 pictures of weak triggers, you're never going to accidentally trade without momentum, because you're going to know the difference and exactly what it looks like. If you take 25 pictures of a clear path and 25 pictures of a termination condition, you're probably never going to accidentally trade into a termination condition, because you're going to speak to yourself in terms of those rules every time price reaches an area. And then the same thing with that potential to break, guys, that 50-50 look. You're going to understand when that's present. You're going to understand that the advantages aren't there. But it's not just taking pictures, and this is such a key part of it, is you've got to annotate your pictures. You've got to write on your pictures, and you've got to talk about the whys. Why are the triggers strong? So physically type out, my triggers are strong because the smalls are above the large, because they're wide, because the scissors are open. This means the advantage of momentum. This is rule number 1 being met. And guys, this is what the spreadsheet that I give you, there's a 101 section. And when you talk about strong triggers, when you take that picture, if you take 25 pictures and it says smalls below the large, all of them are red, there's space between, this is strong triggers, this is odds favorable momentum, guys, you're never going to miss that look. You're always going to know when you have momentum. And the same is true on weakness. If you use the words on every picture, if you take the time to type it out, you're going to be able to say, market reversed with weak triggers. Weak triggers, smalls inside of the large, loss of momentum. Anything can happen. Weak triggers make it hard to trade. You're not going to get caught out on it. So you guys that are brand new with me, V Crypto, Pluto, even Andrew Z, you guys have been here a little bit. Doug, nice to see you in here. You guys that are saying to yourself, man, I'm not hitting the mark the way I want to hit the mark. I'm not getting the results that I want to get yet. Go through to this 101 section. Take your 25 pictures of each. Annotate them. Drop them in the room. Say, hey, Mark, did I do this right? Did I get the right picture? Did I use the right annotation? Am I actually looking at strong or weak triggers? I'm telling you guys, it will pay huge dividends for you. And I'm also going to give you this. I'm going to drop all of this in the room, guys. This is the high probability trend trade checklist, and this actually gives you a visual of what it means to have the rules met. When you look at the checklist, this is the one with pictures. I'm also going to give you one. There's the chart reading 101. I just dropped that in the room. I'm also going to give you a high probability trend trade checklist that is just a printable version, something that you can put on your desktop to police yourself, to talk to yourself. Guys, this is a high probability trend trade checklist when you're using crude oil, S&P, gold, RTY. For you guys that are adrenaline junkies and want to trade the NASDAQ, this is not a NASDAQ checklist. I just want to throw that out there. This is a beginner's checklist. High probability trend trade, guys. I've never had anybody in the history of this checklist use it to the letter and not do at least 70%. So print this out. Get your biggest, most delicious crayon and make sure you can mark yes to each of these. This is what it means to have a strong top or bottom, a no termination condition. No triggers through termination condition, reverses the market, sets you up for the highest probability trend trade. Odds favorable momentum, anything can happen. You should never confuse the two. No clear path, potential to break, now it's broken. A little bit of study, you'll never make that mistake. And exactly how to pinpoint where the market is most likely to continue, guys. So now you have chart reading 101 to develop recognition. You have a high probability trend trade checklist to print out and put on your desktop. And come on, get in the room. Man, it's not letting me drop it in the room. And I'm going to give you the high probability trend trade checklist with the pictures attached. I'm going to try and drop that in the room right now as well. There we go. What else can I give you? You know what? Let me give you my spreadsheet that's got a huge head start on your 101 there. But guys, put your own 25 in there. If you don't, you're not committing the lessons to memory. You're not going through the process to make it happen. And then finally, I'm going to give you guys one more thing. Let me close some of these out. I'm going to give you what's called the KISS plan. And I'm going to give you a KISS plan for a high probability trend trade. And I'm also going to give you a KISS plan for that 50-50 potential to break trade. Let me open it up. This is your KISS plan. And guys, your KISS plan is defining entries. Your entries on the spreadsheet that I just gave you, there's the sequence for a long and a short, and there's the most mechanical management plan from the KISS plan. All of that is available to you on the spreadsheet that I gave you. But this KISS plan, ladies and gentlemen, is a stepping stone in your learning journey. This KISS plan is not the end of the road. This is not the last trade you'll ever take, this high probability trend trade. This could be the only trade that you ever took. And you would have a trade that typically wins 70 to 80% of the time. And you would find yourself more often than not winning trades. But you guys get bored. You need more. So let this be the foundation that you grow from. Let this be the trade that teaches you to speak to yourself in terms of advantages. Let this be the core of everything that you do, guys. This optimizes your chances of success with the high probability trend trade. And then through simulation, through study, through class feedback, and continuous practice, you will be empowered to craft a plan that's tailored to your personal goals based on your experience reading the indicators. That's AI saying, guys, when you can read your charts, you're going to see opportunities. Learn to read your charts, and then you'll see 1,000 patterns that produce profits. And your simple plan for consistency, guys, is don't fight the large chart. Don't fight the momentum on the large chart. Don't trade into those areas on the large chart. If you can do that, if you can commit to that from day one, guys, you're going to eliminate like 70% of the mistakes that traders typically make that result in losses. And then you've got to define your entry. I always encourage you guys, it has to be your plan. Trading is not a team sport. Trading is you making decisions based on advantages. So you've got to define your entry. And when you're using that spreadsheet to go to, come on, spreadsheet. Oh, I've got it over on the other monitor. When you're finding your favorite looks, guys, it's got to be your favorite looks. It's got to be your personal plan. It's got to be what it's going to take to get you in the market, not what Mark said should get you in the market, not what Mark said is the KISS plan. Go ahead and own it. Make it yours. Commit to it. Follow your rules, not my rules. And if you can mark yes to each and every one of these, guys, you're in the market on the highest probability trend trade possible. You're in the market with a trade that typically wins 70 to 80% of the time. And then you've got to do something with it. You've got to manage it. Great entries create manageable trades. Great entries reduce risk. Great entries create higher profit potential. So I'm going to go through this, guys. Everything that you do as a brand new user needs to be rules met on the large chart, needs to be odds favorable, needs to be clear path. Give yourself the highest chance of success and wait for the reversal bar. But don't enter on the reversal bar. It just signals the pullback, right? Don't enter when it hits the triggers. The triggers aren't where we expect it to bounce. So when you get the reversal bar, identify your triggers. Are they one on top of the other? Are they stacked? And if they are, life is good. Find the areas within, guys. Pinpoint your window of opportunity from the lowest point of resistance to the highest point of resistance inside of favorable large triggers. This is where the market is most likely to continue, guys. This is from the spreadsheet, so you have this. You're not entering when it hits the triggers. You're not entering on the reversal bar, guys. You're taking that window of opportunity, that lowest point of resistance inside of favorable large triggers, and you're going to activate a limit order a tick or two below it and pray. Pray that the small crowd ate their Wheaties, that their uncle gave them an extra $1,000, that they can fight all this momentum, all this clear path to get up to your entry, guys. And if they make it, congratulations. The first step is done. You're now in a high probability trend trade from the point where the market is most likely to continue. And now it's time to manage, guys. If you allow management to be as mechanical as entry, it's going to get you to the point to where you start developing trust, because you have to be able to read your indicators to manage trades. So your management plan begins with great entries. I'm entering where the market is most likely to continue. My initial stop is going to go 4 or 5 ticks beyond that window of opportunity, preferably outside of the trigger lines, beyond that correction point. And there's nothing for me to do. I'm either going to get stopped out for a small loss, it's a normal part of a positive equity curve, or all of those advantages in that bounce point are going to come into play, and it's going to give me a reversal bar in the direction of my trade, guys. If I get a reversal bar in the direction of my trade, then I will move my stop 2 ticks above it in this short trade. If then, that's it. Not if I enter at the best spot and I start to get scared, I'll tighten up. If I enter at the best stop, I'll go break even instantly on the first fluctuation. Guys, you've got to keep it very methodical in the beginning. If I get a reversal bar, then I'll reduce my risk. And there will be nothing for me to do until it either hits my first stop or my first target, or it hits my stop. And I don't know which is going to happen, guys. I don't know if it's going to hit my stop or my target. I will never be in control of that. Ever. But what I do know is that if I move my stop too soon, the fluctuation took me out before I ever hit my target. So keep it mechanical. If it hits your first target is $100. I've done this for a reason in the KISS plan, V. I've done this for a reason, Pluto. I've done this for a reason, Doug and Clara and Kenny and Kenan and Andrew and all of you guys. Getting paid creates confidence. Getting paid is the goal. Getting paid dries up sweaty palms and kills the butterflies in your belly. And that $100 creates a confidence, guys. And that $100 feels good. And that $100 has children singing songs about you. And once that first target of $100 is hit, you're going to go break even. You have absolutely no risk on this trade, and you've been paid. And the only reason that we do that in the KISS plan is because it makes it easier for you guys to hold for the second target. Because once you're here, you guys are dying to tighten up to save profits. You guys are dying to move stops, to move targets. Let it play out, guys. Either get stopped out, break even, or let it run to the second target. And if it runs to the second target, guys, that's 2 contracts, high probability, mechanical management. That's a $300 trade, guys. And if $300, if $150 per contract is the best that you can do every day, the best that you can do every day, guys, that is based on 252 trading days a year, $75,000+ a year. You don't have to catch every move. You don't have to catch every penny. Catch the best moves. Capitalize on profits. And guys, this is your first trade. That's your mechanical management. It is right here in the KISS plan. And then the cool thing is once you start to see these entries, once you start to gauge these exits, you're going to understand when you can hold for bigger moves, and you're going to start to annotate and look and see. And what you'll find is that when you have the perfect entry on odds favorable momentum and a clear path, that momentum and clear path is going to say, hey, let me give that next one a chance. Let me let it run a little more. Let me still get paid because that's the goal. Let me get rid of my risk. But let's see if that last one can make it to key areas. And just a heads up, this one did. This one made it all the way down to that key area. And that $300 trade, $400 trade turned into about an $800 trade. So that's my first hour every hour, ladies and gentlemen. That's it. Every day we talk about 3 rules and 2 charts. Every day I give you a way to take this trade the best of the best. And I also give you the KISS plan for the 50-50 trade, guys. The 50-50, the one area not broken, that potential to break trade. And this one, once again, I'm going to use that same language. This KISS plan for the 50-50 is designed to optimize your chances of success on the 50-50. This is not a clear path. This is not high probability. This is not a trade that typically wins 70 to 80% of the time. This is a trade that is betting on the potential based on momentum. So first thing to do is make sure that it's just one area not broken. The more areas you have not broken, the more decision-making places are there, the less likely it becomes to win. Again, this is beginner. Make sure that you have strong top or bottom, that it is coming from a termination condition that reversed the market. That increases the likelihood of success. Doesn't guarantee it, but it increases the likelihood. Odds favorable momentum on both charts because we don't have a clear path. And I like showing this. Because I don't have a clear path, there's no way I'm going to give up momentum. I'm not giving up 66% of my advantages, guys. Which means that no divergence on the 5-1. Can't have it. If you do, no trade. Divergence is the #1 killer of these 50-50 trades, guys. The most taken trade is the 50-50 trade. You're going to get in, and then it reminds you. If there's divergence, no trade. And if you scroll down to management, it reminds you. If divergence prints, exit the trade. And guys, the cool thing is this is not a high probability trend trade. So the management will be different. You have to know what kind of trade you're getting into so you know how to manage it, which is why simplicity in the beginning is so easy. You've got one entry rule set and one management set. Once that becomes second nature, let's add this trade. You have a $100 target, right? Or the first trouble spot, the first fib, the first 1-to-1, the first divergence. And sometimes that first trouble spot is going to be $70, not $100. You have to decide whether or not you're okay with that. And then quick profits on the second because it's not high probability. So that'll be your second trade, guys. And that's what we call a medium probability trade. A high probability trade is when each indicator on every chart agrees for the trade. It's the best of the best. A medium probability trade says that most indicators agree. However, a small issue exists, and you're going to have to use your chart reading to manage around that. So, Jonathan, every day you listen and watch the first hour, you learn something else. I love it, and reinforce all that you've learned. Isn't it crazy? It's funny, guys, because it's easy because of ego, I think, to feel like, well, I've heard this 3 times, I got it, let me go do it. But when you hear it 30 times, 50 times, and it's the same with pictures, when you see the same patterns 50 times, it begins to just sink in. And all of these trades on the client trades from the spreadsheet that I gave you guys, these are you guys doing great things. And not all of them are high probability, but I want you to see something. If I click on the perfect trend trade long, I have odds favorable momentum, and I have a pullback to support inside of favorable large triggers. And if I do the same thing, if I click along on another picture, odds favorable momentum and a pullback to support inside of favorable large triggers. And if I do it again, here's a high probability trend trade short. I'll be damned, it's odds favorable momentum and a pullback to resistance inside of favorable large triggers. This person even uses the spreadsheet or the checklist. So it's seeing the same thing. It really does make it easy. The more times you see something, the more times you type on a chart of what it is you see, the easier it becomes to catch it. So right now, check it out. I've got odds favorable momentum. I've got the potential to break. If I get a reversal bar right here, guys,
order submitted.
I need an ATM strategy. Uh-oh, I think I just froze up. Damn it. And Jerry, after more than 8 years, you're still learning? Jerry, you've been at the software longer than I have. Twice as long as I have. I learn every day, guys. I learn every freaking day. And I just screwed up my NinjaTrader somehow. I don't know how, but I did. I locked it up. Every day I learn something new, guys. Every day I see a new pattern. Every day I learn a way to reduce my risk a little bit. I learn a way to increase my profits a little bit. I learn a way to manage more aggressively, more assertively, more relaxed. And man, when you do this every day and you just focus on the process, it's pretty outstanding how quickly you can get to where you want to be. I have to pull my NinjaTrader back up. I killed it. Sorry, guys. I do that a lot. I mess with my NinjaTrader so much that it's tough. Jonathan, you say today was the best, maybe because of the holiday break. Is the market moving well today for you, Jonathan? Guys, that's my first hour. It's the same hour every hour. Or every day, sorry. And everything revolves around the three advantages. Everything revolves around being able to speak to yourself in terms of momentum, clear path, and entry area. Because once you can do this, once you can say the words out loud, I have momentum, my path is clear, let me find an entry area, you're going to find 100 different entry areas. No, you don't stink. You're actually good at this. Believe it or not. Jonathan, you're at the point right now where you're beginning to read your indicators, but you're not sold on your rules yet. You're skipping the part that pays dividends on your small chart by defining your entry and trying to repeat it every time. So you're close. You're doing what you need to do. But you're so focused on the money still that you're not, you're just not there yet. But you're getting close. You're definitely getting close. And I know this, Jonathan, because I've done it. I've done it 100 times. I have done the exact same thing where I wanted the money and not the process. And you eventually realize that it's the process that yields the results, not the other way around. We all do. We all want to get paid. But it's very much, and guys, I very often I relay my quest on golf. I relay it to trading because I think that there's a lot of common themes that go with it. So yesterday I went and played golf, guys. And my previous round was probably the best round of golf that I've played maybe in my life. And it was because I followed my swing rules. And I did everything right. And yesterday I went out and I went and played golf. And normally, for me, I have simulator first. Normally for me, I go and hit 50 balls on the driving range to get my mechanics down, to make sure that my body's following the rules, to focus on the shot and not the score, Pete. Exactly. Well, yesterday they didn't have range balls. So I went out to the course. And the 50 balls that it usually takes me to get into my groove were my first 7 holes. True story. I shot a 56 on the front 9 yesterday. And if you play golf, you know that that's absolutely horrible. I found my swing. I got my mechanics down. I embraced the process going into the 8th hole. And starting on the 8th hole until the 18th hole, I hit every fairway. And I was hitting greens in regulation. And I shot a 56 on the front 9 without my mechanics, not following the process. And I shot a 43 on the back 9 when I got the mechanics in place. But you've got to learn the mechanics, and it's a process. And just because you know it one day doesn't mean that it's automatically going to hit the next day. So every day you've got to wake up. Every day you've got to wake up speaking about these advantages, talking about what it takes to get you in, reinforcing the rules. It was an amazing comeback, but a 56 was nothing but frustration for me. So if you golf, you're like, oh, I totally get that. If you don't golf, I don't know. It's like fishing for 78 hours and not catching anything, maybe. So, all right, guys, there's crude oil. Guess what? Day after a holiday, it's not giving you a whole lot. I'm going to go take 5 minutes. I'm going to stretch my legs and take a deep breath and refill my water. And when I come back, we're going to look at the charts that you guys have posted. And guys, I'm telling you, the market's not doing a whole lot because you guys aren't posting a whole lot. We're probably going to call it early and go enjoy our weekend. So I'll be back in just a couple minutes, guys. Talk amongst yourselves. All right, guys, let's get back at it. Man, look at that rule number 2 win all over. This is what a consolidating market looks like. I'm going to scroll up to the top of the room, guys. I'm going to start clicking on the pictures that you guys posted. And we're going to see what's going on. Dun, 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 dun. And Cheetah, we will talk about NASDAQ entries. Cheetah, did you see the little series that I put in there for the 10-2 entries? That was for you. And then Steve Diego, man, I already gave you an earful on this one, but I wanna do this. If you scroll up, they're in there. Sure, Pete, I will, and it depends on the market, but I'd be happy to. Guys, this is pretty cool, but this is one of those things where if I go back and look at a market, I want you guys to see this real quick. So let me take this right here. This is what people do a lot. Is they take this look and they go back and they tighten this one up. And they're like, man, so I could have gone long right here and then gotten out right here at this pink line and then gone short and then gotten out at this blue line. And then, man, I would have gone long and short and long and short and long and short. And I only would have made about $800 or $900 right here. And then I would have gone long and made another $1,000. And then I knew to go short right there. And I would have held that short through here. And the reality is that there wasn't one rule met. But if you scroll back historically, you will convince yourself that you are an absolute badass and that you would have made all the money even though your rules weren't met. And I'm saying that because this is kind of one of those situations where you do have a strong bottom, and that's a beautiful thing to help break these areas. But guys, when you run into a termination condition and you still have 4 areas that aren't broken and you've got large triggers against you, man, and divergence off of 1-to-1s, these are trades that are going to absolutely whip your ass more often than they don't. And it's easy to say, man, and then directly into this termination condition with weak triggers, into 1-to-1s with weak triggers, I'm going to take that entry and I'm going to get out right here. And then I'm just going to jump in again right here without momentum, no rules met, and I'm going to take it up to here. And Steve Diego, I'm not beating you up, but this is kind of that siren song of going back historically, and you see all these things. Hey, no worries, Cheetah. Have a good one. Go through those pictures in here when you get a second, because it goes through from seeing it to what I see to the entry all the way through on that 10-2. I did that whole series for you, my friend. So, guys, it's easy to say this is what I'm going to do. It's harder to say my rules are met. Yeah, Doug, I would be a hindsight billionaire. But I don't have any rules for any of these, really. And maybe Steve does, and that's cool. So if they fit your rules, outstanding. If they don't fit your rules, avoid that temptation, because what you're doing is you're telling yourself that it's okay to trade into a termination condition when the small chart tells you it's likely to hold. And it's okay to trade into a termination condition without even the advantage of momentum, and it's okay. So just things to think about with those. Hindsight, though, it's beautiful. Hindsight, there was so much money to be made there. But I just don't have any rules met, and Steve may have them met. And it may have been a great opportunity for him to make some money. But because I'm looking at things revolving around rules, I'm obligated to say that. And then Ron, Pete usually gives me heartburn. Ron's going to do it today. So this is chart reading, and this is pretty cool. This is the counter trend trade. White bar really shouldn't work trade. You don't even have white bars, Ron. But guys, let's go through the whole read, and I want to show you what happens when you become a chart reader. If you're a brand new user, If you're a brand new user, you see odds favorable momentum and the potential to break, right? That's the first lesson. That's that foundational lesson. Ron sees a divergence and he says, uh-oh, we're slowing down at a fib. And he sees a second divergence and the trigger's starting to weaken. He goes, whoa, they're confirming that they're slowing down at a fib. And then he sees another divergence in weak triggers. He's like, you know what? With all of these divergences, with only the potential to break, he says, let me get to the other side of the small triggers and take it up to here. Oh, that white bar, I got you. He says, more often than not, multiple divergences on a 50-50 are going to take me up to the reversal bar marker here. That's a plan that he created based on his ability to read his entry. Sorry, Ron, I was thinking range chart. And he's willing to take this risk, and he's identified a pattern, and he's created a set of rules. And guys, this goes against everything that I tell you as a brand new user. Don't fight the large chart momentum, right? That goes against everything that I tell you as a brand new user. But I also tell you guys that once you can start reading indicators, you're going to start seeing more. You're going to find more opportunities. You're going to create your trading plans. So don't play trade police. Understand that there's a lot of opportunities once you're a chart reader. And Ron, even though it makes my hair grayer than it already is, I love your trade. Because I know that it's rooted in rules, that it's rooted in patterns, it's rooted in chart reading. All right, Miss Adriana, let's see what you did. Adriana says that when a termination condition reverses the market, that's a strong bottom and it makes me happy. And since she didn't annotate a chart, I'm going to help you out with this. And she says that when a termination reverses the market and gives me the best momentum look that I could ever hope for, and then price pulls back to support right inside of triggers, she says, well, I'm just going to get paid. I see a 625 hiding over there, Adriana. Guys, this is beautiful. This is one of those 50-50 trades. Every advantage. And some of you are saying, but Mark, there's divergence on that 50-50 trade. And you're absolutely right. And if you're a KISS plan trader, that's not your trade. But with a little bit of study, you recognize that a strong bottom creates advantages and maybe you're willing to take that trade. Nicely done, Miss Adriana. And then Joel, termination reverses the market, odds favorable momentum, clear path, perfect pullback right to the triggers at the correction point. You get paid, and then up here, what is that? That's 51. So it's right about here. You held it. I like getting paid at areas. Great job though, Joel. Good looking trade. Adriana, enjoy your weekend. Go do some beach stuff. And you know what's funny, guys? That is the entire amount of pictures for the day. And that's okay. So Pete, you wanted, oh, Jen, there she goes. Jen's like, you know what, Mark? We're done when I say we're done. Pivot stop out, absolutely. 50-50 trade, absolutely. Divergence on a 50-50 trade with big split triggers. Another divergence, very split triggers. This is Jen just saying, hey, guess what? No trade. I remember, Jen, because I was going to yell at you. Small's not outside of large. Are you sure about that? It looks like the smalls are outside of the large, doesn't it? They're not inside the large. They're below the large. There's space between the two. And maybe we have a difference of a visual here, right? At the time of the pullback is where I'm looking for that. That's pretty good, right? You meant here? When it reversed? They're still outside. There's the gap. I just drew an arrow right through the gap. They didn't get inside until the bars were all the way up here. They stayed outside till all the way up there. Do you see it? So that's a great momentum look. There's 1,000 other problems, but that is the look. That's the momentum look. We're looking for that odds favorable right at the pullback. So sorry I yelled. Yeah, I saw a picture this weekend that said Australians are just British Texans, and I laughed because I think that might be true. But this is great, right? The triggers get through, so it's not a strong top. It is a 50-50, but guys, look at this. It's a 50-50 on 1, 2, 3 areas. Divergence prints, triggers are split, and Jen says, that's just not my money. I'm going to sit this one out because it's not pretty. And I love that, Jen. Great job. What do you think? Is it trading into resistance, Kenan? I think you mean support. So, did price reach 83.70? Let's walk through it. Let's talk through rules. And let's start with it first. You had a termination condition. It reversed the market. You have odds favorable momentum. Did price reach 83.70 before the pullback? It didn't, did it? So let's only talk about it in terms of rules. If I'm talking about trading into an area, price has to reach that area first on the large chart. Does that make sense, Kenan? This is the lesson that I really want you to know. Not okay. Okay means shut up, Mark. I don't know what you're talking about, and I don't want to let anyone know. So I'm just going to work through it. Don't do if you get in here, right? There is no you. I'm not taking this trade. I'm teaching a class. How about if I get in here and get out here? Is this trading into support? My recipe for support, Kenan, is in order for an area to come into play, price must reach the area. The rules for divergences, or not for, excuse me, the rules for a termination condition. 1, price reaches an area. 2, and since this is support, triggers remain above, right? I want you guys to see how easy it can be, how you don't have to wonder. So you can see that your pullback started from 80, which means that you were right here, Kenan, which means that you didn't reach the area. Pretty cool, right? But do you recognize that you were 50-50? Or actually, you were trading directly into the termination condition. You were trading directly into a divergence low with no triggers above it. Does that make sense? Because your pullback started at 80, and 80 is right here, which means that it was this bar right here that you pulled back on. So if I scroll back to that bar that you pulled back on, and I blow this up, that's big, isn't it? Here's my potential termination condition. Here's your small triggers. So the rules for termination conditions, Kenan, are met 100%. You reached an area and the triggers remained above, so it was a termination condition. Does that make sense? Cool. So yeah, you traded into a termination condition. So it's easy to say, man, if I jumped in right here at the top of this bar that didn't make an area inside of favorable large triggers and got out right here, I mean, you still had momentum on both charts. It would have been a jump in trade and you were hoping momentum would carry you, and it would have. But since the question was it trading into an area, the answer is going to be yes, based on the rules. These are dangerous. You've got 5 divergences up top, and you've got term, term, divergence, term, term. Yeah, good stuff, dude. Great question. Any 3 divergences in the same general price range usually cause major reversals. True of all chart time frames. After a strong termination condition like the one shown here, the trigger lines are strong. They will usually cause the market to break the next support. I don't disagree, Steve. I don't disagree, not at all. So let me expand a little bit. And it's the same reason that we say that a strong bottom typically is the basis for a successful 50-50. So this strong bottom, I love it. Everything about it. This says that this fib is more likely to break. Does that make sense? So here's your first one where I'm expecting the potential break, right? And I like it. And then there's your second area. And then there's your third area. And then there's your fourth area. And then there's your fifth area. So strong bottoms are great. They really are. And if I'm going to take a shot, Steve, using strong bottom to validate broken rules, I'm going to do it on this fib right here. This is the one that I'm like, man, I'll probably get in here down at support, and I won't worry about this one quite as much because it's right there, right next to that decision-making process that started things up. But the further I go up the chain, the less impact that strong bottom has, right? It was a strong bottom. Well, I'm not expecting these to just shatter because it was, holy crap, 100 ticks ago. Does that make sense? And this is honestly one of those things where this is one of the chart reads where my brother and I go back and forth a lot. I firmly believe, and let's see if we can find maybe a live example, and maybe not in a consolidating market, right? Come back, come back, come back. So like this weak triggers no through. I'm taking this 50-50, right? I don't expect this blue fib to do much. The stuff between here and the mid band, I expect it's got a way better chance of breaking. But once I get to the 1, 2, 3, 4th area, it's still just a 50-50. It becomes a tougher trade. So you're absolutely right, 100% on the way you were reading that. But I'm more inclined to say that this one is more likely to break. And the further you get away from it, that advantage goes away. Does that make sense? But it totally clears up why you did what you did, 100%. And when I said, as long as you have reasons, don't let me talk you out of anything. My job is to point out advantages and disadvantages. So we're good. All right, Pete, reversal bar. You guys ready for a reversal bar marker lesson? Thank you for sharing that, Steve. I know you do a lot of study, and you probably are not a willy-nilly kind of guy. Reversal bar markers. All right, so Pete, the first way that we teach reversal bar markers is to recognize, and let me pull it up here. Let me go to the Nexgen site real quick. Oops, I missed my click. No, Steve, I think you're crazy anyway. That's why I like you so much. We're all crazy, aren't we? No, you're good, and that makes sense. And that's why I try not to, guys, when I talk about do what you want to do, right? Ron's trade is freaking asinine. Ron's trade breaks every concept of sensibility that I have in my head. But Ron's trade is such a well thought out, practice developed trade that I know that he knows exactly what he's doing. And guys, just because I don't understand what you're doing in the get-go, explain it to me. Calm my nerves. Pretend like we're in a court of law and you're defending your trade, right? And Steve, that's exactly what you just did. And you did it well. You said, well, Your Honor, Exhibit A, strong tops and bottoms make these areas more likely to break, and that was the basis for what I did. And I'm like, oh, Steve, perfect. All right. Pete, are you with me in here? Did he leave? No, we're good. Pete? So the first way you guys are going to use a reversal bar marker. No, you're okay, Steve. Guys, I don't ever want you to think that I'm knocking you down on the trades that you take. I just want... when you know what you're getting into, you know how to manage. Does that make sense? When you know that it's not a clear path, you know you have to be aggressive. When you know the momentum isn't that strong, you know the areas are less likely to break. And it's this process of always resorting back to the advantages. That's how I try to go in and analyze your charts. So it helps. And I think what it does is it gets you thinking in terms of advantages. All right, so Pete, the first time we use the reversal bar marker is determining if the mid-band is the termination condition. And the mid-band behaves as a termination condition if the large triggers are a full bar away. What does that mean? Let me pull up the picture. Dun, 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 dun. Yeah, me too. Ron, I blew out a couple accounts trying to take your trades, your momentum style trades, because I didn't understand it. Because I have a huge ego, and I figured I've seen it once, I should be able to do it live on an account. All right, so Pete, on your large chart, you're going to see this reversal bar marker. You're going to see this bar that comes off on the side. And let me find my large chart real quick. It's gold on this one. But this is the price at which this bar becomes a down bar. Are you comfortable with that concept? That's really the most important thing that you have to know right off, is what is a reversal bar marker? A reversal bar marker is nothing more than the price that whatever the most current bar is becomes a bar in the other direction. So the first way we're going to use it is to determine if the mid-band is a termination condition. And we're going to use that for the gap theory is what it's called. And just a heads up, there's about 50, probably 25 pictures of the gap theory in patterns that repeat themselves in termination conditions. So good study tool. But what it says is if price accelerates away from the large triggers, if it zooms away from the large triggers and hits an area, and it doesn't matter, it can be fibs, mid-bands, yellow 1-to-1s, divergence highs, divergence lows. But if this were a mid-band, I would have to look, Pete, are my large triggers a full bar away? If they are, the mid-band is behaving as a termination condition. So what happens is when price reaches a mid-band, if my large triggers are below this reversal bar marker, they are more than a full bar away, which means that it's a 100% termination condition. And you see it going up Here's the next picture. Price accelerates all the way down and smacks the mid-band, Pete. Those large triggers were above the reversal bar marker. I know it because, look, I got a full reversal bar and it still didn't make contact. It says absolutely no shorts into this area because it's like a slingshot. And when it accelerates super far away, it typically closes the gap back. So that's the first way that I'm going to use it. That's the large chart usage, is for the gap theory. So if we go back to the large chart again, and what's cool is you'll be able to, like, you could take your indicators off and recognize this pattern after a while. Price accelerates down, gets to the area. This is how we're using it on the 13 too, on your large chart, because I don't know if you're trading NASDAQ or not. And I'm looking for an example. Price comes up, accelerates, large triggers don't follow, it closes the gap. If those triggers are below the reversal bar marker, it's more likely to close the gap. Well, if it's kicking your ass, it's because you're trying to trade it like crude oil. You're trying to trade it like the S&P. See how it closes the gap? So that's the first way we're doing it. And I don't know what the deal is with you guys, why everybody is so hell-bent on trading the NASDAQ. The next way you can use it, Pete, are you good with that one? Are you comfortable with the gap theory? Both, Paul. The same rules for breaking areas. The same rules for breaking areas, Paul. Smalls and large. So this divergence is still in play because the large didn't break. Same is true on the small chart. All right, Pete, so let's go to the next one. And I took some pictures this morning. You're welcome, Paul. Bum, bum, bum. One way I'll use it, and this is for NASDAQ, guys. If you're using a 10-2 for entry on the NASDAQ, and this is NASDAQ. So Pete, this is another way to use it because we're just doing lessons here. If divergence prints from the high or low, do I have NASDAQ traders in here using the 10-2 chart that John Novak was using? Anybody? Raise your hand because this is huge for you guys. This is huge. All right. If divergence prints from the high or low, my rule says if there is divergence from a high or low, come on, picture, I have to wait for a reversal bar. Why did that rule come into existence, and why is that not coming up? Why did that rule come into existence, guys? Because I spend every day looking at patterns, because I spend every day optimizing my chances of success. And what I've found in conjunction with my brother is that if you're trading the 10-2 on the NASDAQ and you get a reversal bar on your pullback, waiting for a divergence on your reversal, you have to wait for the reversal bar, because more often than not, if you don't wait for it, you run the risk of getting run over more often than you don't. So your advantage goes away. So that's going to be the other way that the second way that I use it, Pete. Let me find my pictures again. Hold on. If I get a divergence off of the reversal bar, pulling back on the small chart, the 10-2 on the NASDAQ, guys, this is NASDAQ specific. My rules say that I have to wait for a reversal bar to enter, which means that I'm going to use a sell stop right on my reversal bar marker, right where that reversal bar is 100% confirmed. Because if I try to anticipate it, And let me show you what this one did. It bounced off of those small triggers twice. If I try to anticipate the reversal bar, I run the risk of it running up. But if I wait for the reversal bar, well, then it puts me in, and my risk is already established. And guys, the NASDAQ is a bitch goddess. It gives with one hand, and it takes with the other. So, Pete, that's the second way I'm going to use it. If my rules say that I need a reversal bar for entry, then I'll use that reversal bar where I put my stop order to guarantee that I get it to enter the market. Does that make sense, Pete? All you NASDAQ traders? You pay for confirmation, guys. You will pay for confirmation. But if that payment for confirmation reduces a lot of losers, it's worth the cost. There was no divergence on this one. Could have gone at the areas. Divergence on this one. Wait for the reversal bar. I hope you recognize that's a short trade, Pete. Everything's red. My areas are inside of favorable large triggers down. Yes. So this is a sell stop. Are you familiar with stop orders? That should be the question that I'm asking. Okay, I'm not sure. Not everybody is. There's a little snippet that I put on it. I had no idea what they were when I started. So what a stop order is it says that if the market goes down and creates a reversal bar, I'll put them in a trade. It'll put me in a trade, guys. It's insisting, even though I want to go short, I'm not arbitrarily going short from up here. I'm forcing a reversal bar to get me in. That's it. And then if I get that reversal bar, well, then I'm in the trade. And then the next way that I'm going to use this reversal bar marker. So second higher divergence is a termination, is an exit condition for me. Pete, I don't know if it is for you. But a second higher divergence is an exit condition for me. Well, it takes 3 bars, well, 2.5 bars to let me know if this potential divergence is going to actually be divergent. So I'll put my stop 2 ticks above the reversal bar marker, because this is where I'm going to know whether or not I need to exit the trade. Sometimes it happens, and sometimes, look at that, that divergence potential never came to be. So I had my stop in a logical spot where, whoops, where'd it go? If it would have printed, I would have exited. It didn't print. I stay in the trade. And it's still right there for the second divergence. So when that second divergence printed, it pulled me out. That's the other way that I'm going to use it. And then guys, I want you to see something. I didn't show the large chart on purpose on any of these pictures. I should have never been in this trade. There was no doubt in my mind this second divergence was probably going to take me out. Look at the large chart. The trend is up, the smalls are above the large, right? That's a horrible look. But I did this, guys. Don't focus on small chart if the large chart doesn't say take a trade. No, Paul, sell limit and stop limit are 2 totally different things. Let me show you. A stop limit means that if I right click, sell limit says if price reaches this area, I want to go down. I want to take a short trade. That's a limit order. So if price reaches my sell limit,
order filled.
It puts me in a short position.
Order filled.
It's easier to see when you have stops and targets in. If I put a sell stop, or actually this would be a buy stop, which is above price, what it says is that if price reaches my buy stop, I'm in a long position. So you're going to use these. If you're taking the high probability trend trade,
Order canceled. Order filled.
and let's say that I'm looking for a long trade right at the mid band, and guys, I don't have any rules met. I right click and I put a buy limit, which means that the market has to come back and hit it, and then it's going to continue up. That's my hope anyway. Does that make sense?
Order canceled.
And let's say I want to go short. I can right click and put a sell stop right on the reversal bar marker. If my rules say I need a reversal bar for confirmation, this says the only way I'll enter my short position is if it comes down and creates this reversal bar. So when you right click on your chart,
Order canceled.
a limit order, when you click above price, a sell limit
Order submitted.
means that if I hit 84.05, I'm going short, Paul.
Order canceled.
A buy stop says if I hit 84.05, I'm going long.
Order canceled.
A buy limit
Order
says that if I hit 83.72, I'm going long.
Order canceled.
A sell stop says if I hit 83.86, I'm going short. So a limit order is going to be used to go in the direction, right? Buying or selling a pullback. So if I'm looking for a short trade right here, I have a limit order waiting with the anticipation of it going down. If I need a reversal bar for confirmation, I have a sell stop below price action at the reversal bar marker. Stop orders are what you use when you need confirmation of the move. Stop orders are what you use when you need a reversal bar to confirm your entry. Limit orders are what you use when you're waiting for price to retrace to the area inside of favorable large triggers. So a sell limit and a buy limit do the exact same thing, but in opposite directions. A sell stop and a buy stop do the exact same thing. So if I said I was going short, but I need reversal bar confirmation, Paul,
Order submitted.
I would put a sell stop right there. This says I will take a short trade, but only if I get a reversal bar in the direction that I want to go. Does that make sense?
Order canceled.
And if I put a buy limit at the exact same spot, this says that I'm going to go long if price comes to 83.94, the buy, as opposed to the sell, up versus down. Does that make sense, everybody?
Order canceled.
If you're a high probability trend trader, initially, guys, the only thing you need is a limit order for a long or a short. And then when you start growing outside of that plan and you use things like confirmation bars, you can hit buy now, buy market, sell market, but I think that the stop placement, the buy or sell stop on a reversal bar marker, it reduces your need for reaction time. Does that make sense? Did I confuse everybody thoroughly? And that's what it is. So Muser, you're paying a price for confirmation. But the thing is you have to know when it's appropriate, right? Sometimes people will wait for the reversal bar, and let me pull this up real quick. Some people will wait for the reversal bar. Let me go to the entries real quick, and I'll show you what I mean. So for a brand new user, it might be terrifying to buy the market when it's on its way down, right? I fully understand that. For the brand new user, you're thinking, man, there's no way the market's going down. I'm not putting a limit order right there. Hell no, can't make me. I don't trust the methodology yet. You'll get there. You'll get to that trust. So they may say, I'm going to insist on a reversal bar. before I ever enter this trade? Well, guys, all you've done is you've added some risk to the trade and you've reduced some profit potential. But that's kind of a nice little whoopee, right? If you're too scared to buy the pullback, buy the reversal bar. That's okay. But your goal should be to develop the trust so that you buy the pullback, because great entries create manageable trades. Great entries reduce risk. Great entries create higher profit potential. So I'll never get on you. Guys, it's terrifying. The market's coming down and you're wanting to go up. Holy crap. Who does that, right? So we're coming off a termination. We have odds favorable momentum. And I'm at a little bit of a sticking point. You guys notice that that's the same sticking point that it's been since midnight? Who's trading into it because they're bored? It's a lot of momentum. But my small trigger hasn't even made it through yet. In the moment, this doesn't have the potential to break even. I need those small triggers to at least get through before price hits that next area. Does that make sense? One bar tells me that I have momentum. One bar tells me, man, you're going to trade into an area here if you take a long. Some people say, well, you know what? Because of the strong bottom, because of this level of momentum, because I can pinpoint exactly where the market is most likely to continue if it pulls back, I'm willing to put in an '07 entry. Fully understanding, because I spoke out loud, that I would be trading into a termination condition. This would break the rules, wouldn't it? But there's some of you in this room that'll still take this trade because of your study. There's some of you that say, you know what, if this divergence is true, I won't take this trade. But if I get a pullback without divergence, I'll give it a shot. Only one is KISS plan high probability, and we don't have the rules met for that. Does that make sense, everybody? And Steve, this goes back to your video. But a strong bottom, right? But a strong bottom. But you still have to look at the whole scenario. All right, Steve. Strong top. Smalls break, weak triggers. Divergence prints. You get in at '07. And this is a 10-2. And then you get a second higher divergence. All right. Fear of missing out. Are these triggers inside? Is this area inside of triggers, Steve? I'm going to go through a correction point lesson real quick. I expect price to come back to the triggers, right? I expect price to close to those triggers. On the large chart, that's it, right? There's my large chart triggers. And then there's my small chart triggers. So if I expect price to come back to these triggers, then already I'm on the wrong side. Does that make sense, Steve? Already I'm on the wrong side of the correction point. Which means I don't know if it's going to be the mid band, the fib, these fibs, this, that, these, those, them, right? I can't line up areas with triggers. So you're absolutely right. The reversal bar at least gives you a fighting chance. That's why I use the word correction point, or the two words correction point, so often. Because once I'm on the wrong side of those triggers, it becomes more difficult to pinpoint where the market is more likely to continue. And it looks like you got your first target. So good job getting paid on that one, without a doubt. And just for grins, I know just above that horizontal. You are above it. If the triggers are a correction point, what does that mean? That means I expect price to come to the triggers. I don't expect price to go beyond the triggers, right? In a perfect world, Steve, price comes to the triggers, doesn't break through the triggers, and ideally bounces off of an area inside of the triggers, right? Once I'm beyond that correction point, once I'm off in no man's land on the wrong side of that correction point, I don't know. Then I'm just hoping areas stop the market, right? You had a pretty good area there. But that's why I use that phrase correction point. Because look what it does. It does break beyond it. And then it just kind of bounces inside of that correction point. Bing, 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 bing. Right inside of those trigger lines. You don't see it on the large chart. I'm sorry, I'm not being clear. This white line represents the line in the sand. I expect price to correct to the triggers. My advantage happens when there's a line inside of the triggers. So here, let me type it out. If my areas are on the wrong side of my correction point, I have no freaking idea which line may stop the market. So, as long as I'm beyond it, and then Steve, the opposite, if my area is right before the synthetic triggers, right? On the way to the correction point, well then I can create an intelligent stop on the other side of the correction point. Here, I can't. Does that make sense? That's why I talk about the correction point so much. And it's the combination of the two. Because once you start to get lines on the wrong side of those triggers, once I get to the other side of those triggers, it just keeps going. Once I get to the other side of the triggers, I'm not sure what's going to stop it. Yeah, no worries. And it's the same thing, right? Once I get to the other side of these triggers, Steve, I don't know. I don't know if it's going to be the fib, the 1-to-1. That's a great example of it right there because that's a pretty sexy looking entry, right? But once it gets to the other side, there's just no freaking telling. Once I get to the other side, this support, that support, this support, didn't do anything for it. Great question. Great opportunity for a lesson there. And then here's the cool thing. Do you see how these areas are right before the correction point? One sec, Pluto. One second, guys. I'm going to try and get Pluto a little bit of help here. Dun, dun, dun. Boom, 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 boom. All right, Pluto. So... All right, guys. Sorry, thank you for your patience. There we go. Yeah, guys, always reach out if you're having a trouble hearing. Sooner than later. And Steve, the way I was going with that one is the cool thing is if your line is right before the correction point, well then your stop still goes on the other side, right? So at least the bounce point is before that line in the sand where we don't want to be in the trade anymore, as opposed to it being on the wrong side of the correction point, in which case you're already kind of into skidding out of control territory. Does that make sense, Steve? This kind of shows it in both sides. Awesome. Great question. And just for the sake of argument, and this will pay dividends for you on the NASDAQ. Let me find the picture for it real quick. So 50-50 trades. 50-50 trades are awesome. The potential to break is amazing. But the one thing that people miss out on a little bit on these 50-50 trades is, in order to believe an area is going to break, Steve, this is my look. Momentum can break areas. When you've got trigger lines, one line is inside, they're barely peeking through. This isn't my hell yeah it's gonna break look. This is my oh god I hope it breaks look. You want to see those small triggers, I mean smash, and you want to look at them smash with odds favorable momentum, especially on the NASDAQ, because the NASDAQ overruns areas a lot, and you've probably noticed that in your NASDAQ trading. Is the NASDAQ will overrun areas for 2, 3, 4 points, and then it turns. There's so much momentum behind the NASDAQ. It's such an angry market that you'll see these little overruns, and then you'll see the reversal happen. Just a little safeguard there. NASDAQ's a different animal for sure. And guys, the buyers are trying, right? They're getting out of that range. We'll see if 84.25 stops it. Great question, Steve. Thank you for that. I love talking about the stuff kind of outside of the normal sometimes. What else you guys want to talk about? Hopefully Pluto gets back in just in time for me to say we're going to call it a day. Obviously, crude oil's not doing much of anything. Yeah, man, go flush it. Monday news looks boring. See you on Monday. I like it. Any other questions, guys? Anything we can talk about for you? This is kind of that free time. If there's something on your mind that you want to talk about, let's talk about. Otherwise, let's go enjoy a weekend. Because the market isn't giving it, right? The beach looked like Woodstock. Was there a big festival out there? I'll have to check it out. I miss the beach. I almost killed myself yesterday in the heat, though. All right, guys. Your strong silence is good for me. So we're going to call it.